Mortgage rates are climbing again, ending a streak of relief that had home buyers and refinances breathing a little easier. With rates now back near 7% and Federal Reserve's most critical meeting of the year just days away, the question is, are we on the verge of another surge or could rates finally turn back down? In this video, I'll be diving into what caused this week's rate hike and the data you need to watch in the days ahead and how you can make the smartest move in this unpredictable market. Whether you're buying a home or thinking about refinancing, this could be one of the most pivotal weeks of the year to lock in the best rate. Let's get started. This past week was a whirlwind for mortgage rates, starting with a promising low on Friday only to see a steady increase every single day of the week. Let's break it all down and see how economic data, the market movements, and external factors shaped what happened. On Monday, mortgage rates opened the week slightly higher, moving from Friday's 6.68% to 6.72%. While this uptick marked the second lowest level in over a month and a half, it hinted at uncertainty brewing in the bond market. The day itself was relatively quiet, with no major economic reports driving the movements. Investors appeared to adopt a cautious stance, consolidating positions ahead of a more impactful midweek data. This was evident in the bond market, which traded within a very narrow range. As we will see later, Monday set a tone for a week of waiting for bigger news, particularly Wednesday's Consumer Price Index (CPI). On Tuesday, rates edged higher again, rising to 6.78%. This slow climb erased nearly a quarter of the gains achieved over the previous 3 weeks when rates had dropped from over 7% to 6.68%. While no significant economic data landed on Tuesday, the market's anticipation of Wednesday's CPI report was palpable. Traders positioned themselves ahead of the key inflation indicator, as it would be the Fed's last major data point before their next rate decision. So, what was the overarching sentiment? The potential for volatility was building, but the exact direction was still a coin flip. On Wednesday, mortgage rates took a roller coaster ride, starting the day on a positive note before reversing course by the afternoon. The highly anticipated CPI report was released. The headline Consumer Price Index showed 0.3% increase month over month, matching forecast and up slightly from October's 0.2%. On a year-over-year basis, headline CPI came in at 2.7%, again aligning with expectations and ticking up from 2.6% the previous month. Core CPI, which includes food and energy, also met forecast with 0.3% month-over-month increase, consistent with October's 0.3%. On annual basis, core CPI remained steady at 3.3%. While these as-expected numbers initially provided some relief for the bond market, the optimism didn't last long. Rates started the day at 0.03% lower than Tuesday's level, but by afternoon, lenders had repriced, leaving rates 0.02% higher at 6.8%. External factors, such as the Bank of Canada's unexpected policy shift, sent ripples through the bond market, contributing to the afternoon volatility ahead of next week's Federal Reserve announcement. On Thursday, mortgage rates climbed further to 6.87%, marking the highest levels in a week. The Producer Price Index (PPI), a key measure of inflation at the wholesale level, showed a 0.4% month-over-month increase, matching the forecast and up from October's 0.2%. Core PPI, which excludes food and energy, also rose 0.1% month-over-month, slightly below the expected 0.2% and down from October's 0.3%. On a year-over-year basis, PPI came in at 3%, exceeding the forecast of 2.8%, while core PPI remains steady at 3.5%. Jobless claims data painted a mixed picture. The initial claims came in at 242,000, higher than the forecast of 229,000 and last week's 224,000, hinting at some potential softening in the labor market. However, this seemingly bond-friendly data was overshadowed by aggressive selling in European bonds following the European Central Bank's hawkish comments. This selling spilled over into the US markets, driving rates higher as traders shifted to a defensive stance ahead of the next week's Federal Reserve meeting. On Friday, mortgage rates rose for the fifth consecutive day, ending the week at 6.95%. Friday's economic data was relatively minor. With a focus on imports and export prices, the import price index for November showed a modest 0.1% increase in line with expectations and consistent with October's 0.1%. Excluding fuel, import prices were flat at 0.0%, down from the prior month's 0.2%. Export prices came in unchanged for the month, slightly better than the forecast of minus 0.2%, but well below October's 1% increase. Despite the muted data, bond markets continued to experience steady selling pressure driven by non-data related factors. This week's data, including the CPI and PPI aligning with the forecast and jobless claims signaling potential labor market cooling, wasn't overwhelmingly negative. Yet, factors like year-end portfolio adjustment and anticipation of next week's Federal Reserve meeting kept traders defensive, leading to a higher rate across the board. This past week was a stark reminder of just how unpredictable the mortgage rate market can be. Despite seemingly neutral economic data, rates climbed every single day, erasing much of the relief borrowers had enjoyed in the late November and early December. Last week, I posted a video titled "Mortgage Rates Under Threat, Inflation Could Spoil Your Future," and encouraged my audience to seize the opportunity to lock in their rate before the inflation data hit. And unfortunately, that's exactly what happened. Rates surged throughout the week. As we head into the next week, all eyes are on the Fed. Their decision could either lock in this upward trend or provide the reprieve borrowers have been hoping for. For now, with rates near 7%, again, it's more important than ever to have a clear strategy tailored to your financial goals. This upcoming week is packed with high-stakes economic reports and events that could have a big impact on mortgage rates. From housing data to inflation gauge and of course the Federal Reserve's much anticipated meeting, let's dive into the key events to watch and how they might shape the mortgage market. On Tuesday, we kick off the action with the US retail sales report for November. Retail sales are expected to rise by 0.6%, with the core reading, excluding autos, projected at 0.4%. These figures are crucial because they highlight consumer spending strength, a key driver for economic growth. Stronger than expected retail sales could push Treasury yields higher, leading to upward pressure on mortgage rates. However, any signs of consumer weakness might support lower rates. At 10 o'clock, the Home Builder Confidence Index for December is set to release. With forecasted increase to 47, this report provides insight into the health of the housing market. Improved builder sentiment often points to optimism in future home construction, which could influence broader housing trends. Then on Wednesday, housing takes center stage early in the day with housing starts and building permits for the month of November. Starts are expected to rise 1.34 million units, while permits are forecasted to be at 1.43 million. These metrics offer a glimpse into future supply in the housing market. Strong readings might suggest resilience in the sector, potentially adding upward pressure on rates, while weaker numbers could provide some relief. The main event, however, is the Federal Open Market Committee or FOMC rate decision at 2 p.m., followed by Fed Chair Powell's press conference at 2:30 p.m. This is the last Fed meeting of 2024, and markets are laser focused on whether the Fed will hold rates steady or make further cuts. Any unexpected comments about inflation, economic growth, or future rate policy could trigger significant rate volatility. Mortgage rates often track changes in the bond yields closely, so keep an eye on this one. Thursday brings another busy slate of reports, starting with initial jobless claims, which are forecasted to drop 229,000. This weekly measure of labor market strength often impacts bond market sentiment. Lower than expected claims could suggest continued resilience in the job market, pressuring rates higher. Later in the morning, we'll see the Philadelphia Fed Manufacturing Survey, which is projected to rebound into positive territory at 2.4. This will be released alongside existing home sales for November, expected to increase slightly to 4 million units. Housing demand continues to be a critical factor for rates, as strong sales pace could reinforce expectations of economic stability, reducing downward pressure on rates. Friday wraps up the week with key several inflation and spending reports starting at 8:30 in the morning. The core PCE price index, the Fed's preferred inflation gauge, is expected to rise 0.2% month over month and 2.9% year over year. Meanwhile, personal income and spending reports are forecasted to show steady growth at 0.4% and 0.5% respectively. Inflation trends are central to mortgage rates, and any surprises uptick in the PCE figures could lead to higher rates. Conversely, signs of cooling inflation may reinforce the downward trend borrowers have been hoping for. Finally, the Consumer Sentiment Index for December will offer insights into how Americans feel about the economy heading into the new year. Stable or improving sentiment can boost confidence in the housing market, but weaker sentiment could keep rates in check. This week is all about inflation, housing, and the Federal Reserve. While most eyes will be on the Wednesday's FOMC decision, data throughout the week from retail sales to PCE inflation will provide important context for where mortgage rates might head next. If inflation shows signs of cooling or the Fed signals a dovish stance, we could see rates stabilize or even decline. On the flip side, stronger than expected data or hawkish comments from Powell could drive rates higher. Now is the time to stay informed and keep a close watch on the market. As always, I will be here to break it all down for you in real time. As we wrap up a volatile week in the mortgage market, here's what the current trends mean for home buyers and those looking to refinance, and why this week could present a pivotal opportunity depending on your situation. Let's take a closer look at the 10-year US Treasury yield chart and what's been happening over the past month. First off, notice this downward channel formation that started around November 14th. Yields steadily declined within this well-defined channel, making lower highs and lower lows. However, something significant happened last week. On Monday, December the 9th, the yield closed right at the top of the channel. That's always a moment to watch because it often signals that a breakout could be imminent. And sure enough, the following days delivered exactly that, a clean breakout to the upside. Once it broke out of the channel, the yields climbed consistently, breaking through key levels along the way. One critical zone to highlight is the 4.15 to 4.20 resistance range. This area had previously acted as a ceiling, capping any upward momentum. But as soon as the yield pushed through this zone, it was like floodgates had opened. From there, it was off to the races with yields climbing steadily higher. Another key event was the gap fill between 4.36% and 4.38%. The gaps on the chart often act as magnets, drawing prices back to those levels, and that's exactly what happened here. Now, as of today, the yield is sitting at 4.401%, which brings us to another critical juncture. Here's the question: will 4.40 act as resistance, or will the 10-year yield push through and turn this into new support level? Let me explain why this is important. When a price, or in this case a yield, approaches a key level like 4.40, there are typically two scenarios. If the yield struggles to move past it and starts pulling back, that suggests 4.40 is acting as resistance, a level where selling pressure or a lack of buying momentum causes the move higher to stall. On the other hand, if the yield pushes through 4.40 decisively, closing above it, then 4.40 flips into a support level. What that means is that instead of sellers dominating this level, buyers step in whenever the yield approaches it, effectively creating a floor. So, what we'll be watching for in the coming days is whether the yield consolidates and holds above 4.4, confirming it has a new support, or whether it serves and retests lower levels. In summary, the breakout from the downward channel, the move through 4.15 to 4.2, and the gap fill at 4.36 to 4.38 have all been significant technical events. Now, all eyes are on 4.40. This could very well determine the next leg of the move. Will yields continue higher from here, or are we due for a pullback? Only time will tell, but it's a level worth keeping on your radar. For home buyers, mortgage rates have risen steadily this week, climbing back towards 7% after a brief reprieve earlier this month. While this uptrend may seem discouraging, the key question for buyer is timing. If you're actively shopping for a home and have found a property you love, locking in your rate now is likely the smartest move. With the Federal Reserve's upcoming decision next week and no guarantees of lower inflation in the near term, the risk of waiting outweigh the potential rewards. A Fed statement perceived as hawkish or inflation data showing any unexpected spikes could push rates higher, eroding affordability further. Even at today's rates, securing a fixed 30-year mortgage locks in your housing cost, shielding you from future increases and giving you predictability in an otherwise volatile market. Plus, as rates rise, home buyer competition often eases, which could give you a slight edge when you are negotiating on a price. If you are early in the buying process, stay prepared. Rate volatility means opportunity can arise quickly, especially if next week's data surprises to the downside. For refinancers, refinancing in today's environment depends heavily on your current rate and financial goals. Rates are up this week, but if your existing mortgage is above 7%, there is barely any room left to save by refinancing at current levels. But for most of you, it might be worthwhile to wait. For those in a position to wait, there's a reason to hold off temporarily. Next week's core PCE inflation data and Federal Reserve's rate announcement could provide more clarity. A dovish signal from the Fed or cooling inflation might nudge rates back towards the level seen earlier this month, opening up a better opportunity to refinance. This is a market where decisiveness matters. If your situation demands immediate action, whether it's securing a home or reducing your monthly cost, locking in now is prudent even if rates feel higher than ideal. But if you have the flexibility to monitor next week's critical data, you could benefit from waiting for any signs of rate improvement. The bottom line? Stay informed. In this market, preparation is the best way to stay ahead. This past week's mortgage market has been a real roller coaster, and if there's one takeaway, it's this: staying informed and ready to act has never been more important. Rates climbed steadily this week after hitting their lowest point in over a month, leaving many borrowers wondering what's next. For my subscribers, you know I've been posting daily updates on rates and providing clear guidance along the way, helping you navigate the unpredictable swings. Whether it's heads up about key inflation data or advice on locking in at the right time, I'm here to ensure you stay one step ahead. With key inflation data and the Fed's final meeting of the year just around the corner, we are heading into what could be one of the most pivotal weeks for mortgage rates this year. The market could swing either way, depending on how the numbers land, so having a clear plan is crucial. If you are shopping for a home or considering refinancing, now's a good time to act decisively. Locking in today's rate might save you from further increases, and if you are still waiting for the right moment, make sure you are prepared to move quickly if rates improve after next week's report. If you haven't already subscribed to this channel, now's the perfect time to do so. I'll provide daily updates on mortgage rates and share timely advice to help you lock in at the best time possible. By subscribing, you'll stay ahead of the market changes and make confident, informed decisions. As always, I'll be here to help you make sense of it all. If you have questions about your options, need advice on locking in, or want a second opinion on loan estimate, don't hesitate to reach out. And hey, let's get the conversation going in the comments. Where do you think rates are headed next? Do you think the Fed will surprise us? Or will they stick to the plan? Before you go, don't forget to hit that subscribe button and turn on notifications so you don't miss the next week's update. I'll be breaking down the Fed's decision and what it means for the housing market heading into 2025. Thanks for tuning in, and I'll see you in the next video.